Hi, everyone, and welcome to Montaka Global Investment Spotlight Series podcast. I'm Jessica, and today I'm sitting down with my colleague Lachlan Mackay, who just returned from the Bernstein Strategic Decisions Conference in New York. Lockie, how are you?
Hey Jess, I'm doing well. How are you?
Yeah, good, thanks. I'm excited to be here for our second year covering this conference. For our newer listeners, could you give us a quick rundown of what the Bernstein Conference is and why we like it at Montaka?
Yeah, of course. The Bernstein Strategic Decisions Conference we've been going to for a few years now. We figure it's sort of the premier conference for what we like to look for with companies, being strategic decisions, the companies that are there. There's probably around 100 that bring their CEOs, their key decision makers. And instead of sort of the usual interfaces with investors where it's quite short-term, quarterly focus, they really speak to the long-term decisions that they're making, thinking about big structural trends, big growth drivers. AI is a very big topic in this one, for example. And so it's a really good download for us where you can see across a range of sectors everywhere. There's a lot of financial services. You see the big restaurant groups. You see the payment network. There's big energy companies, big defense companies, a whole range of sectors all bring their key leaders to New York for this conference. So it's a really important one for us, and hopefully we can share with you some of the bigger insights that we gathered from the conference.
Yeah, amazing. Sounds really wide-ranging, and I'm excited for you to share some of the things you've heard about this year. I know we've got a couple of big themes to cover, from AI adoption to data to the macro backdrop. So maybe let's jump right in with everyone's favorite topic, of course, AI adoption.
Yeah. AI honestly was question one for just about every one of these companies. It's the topic of the day. And every single one of these companies was asked how they're deploying AI, how they're using it. And my favorite answer was actually from MSCI, which is somewhat surprising because you wouldn't consider them to be the most tech savvy, cutting edge adopters. But their CEOs actually made AI adoption a condition of employment. So given everyone the tools and the training they need, but if you're not willing to use it, I'm sorry, that's it. And they're accelerating their product development as a result.
Yeah, wow, that's super interesting. And it definitely makes me think about how businesses are treating AI adoption as this huge sprint, like not just from a technical deployment perspective, but also culturally and behaviorally. For example, I'm sure you've heard, and some of our listeners may have heard about big tech companies token maxing, which is where employees are actually incentivized to, or even pressured to, maximize their entire AI token usage. I'm curious to hear, though, if you heard about whether these companies at the conference who are going really hard on adoption on multiple fronts are the ones who are seeing the most meaningful productivity gains, or if it's a little bit too early to say.
Yeah, I mean, it's tough to say exactly for their customers. That's probably the next step in terms of getting products out the door that the customers actually adopt and drive real revenue going forward. So we're probably a step before that, where each of the companies are thinking more in the terms of productivity of their workers in terms of hours saved or the amount of code shipped or the amount of products that they're dropping. It's still sort of yet to be seen exactly how productive that will be in terms of their economics going forward. But for example, JP Morgan, very early adopter of technology across the board, they've got 150,000 employees saving 4 hours per day using all of these AI productivity tools. You can think of all the stuff that investment bankers do that AI can pretty easily replicate now. Robinhood as well, they're quite tech savvy, and they've clearly, like, I don't know if I want to say they're token maxing, but they're certainly driving code shipped as a key metric. And so the amount of code that they're developing has grown by 50% year over year. And so
Yeah, well,
they're developing a whole range of new products that they're putting onto their platform.
yeah, wow. It's early days, but we're seeing big outputs, and I guess the outcomes will be the next big question. And I think that's a great segue, because if AI is the fire, then there's a question of what's the fuel, which is where the data story gets really, really interesting. And you flagged that another theme coming out of the conference was around unique proprietary data sets becoming more and more valuable in the age of AI, which is also a topic, incidentally, we cover in our latest white paper. and a view that we very much subscribe to here at Montaka. So can you walk us through what you heard?
Yeah, of course. I mean, yeah, we're speaking our own book here, but it was nice to have some of our thoughts reinforced
For
by
sure.
all of the leaders at the conference. Um, Absolutely, like AI is clearly only as good as the data that it's trained on and then inferenced on, and that was seen across the board, especially across the financial services sector. So, for starters, S&P, which is one of our core holdings, um, they actually believe that the rise of agents has structurally increased the value of their IP. Not only are agents using their data more, but they've actually found that one, their distribution has gotten wider because you can distribute it further into the sort of the AI interfaces like an Anthropic Claude or an OpenAI ChatGPT.
Hmm.
Um, but on top of that, actually, they've got clients who really do want to use AI through an LLM interface, but they don't trust the results of their conversations with AI. So it's expanded their
Mm.
distribution reach. Um, it also means that when customers change the way that they interact with their data, so in the sense that they might use it through ChatGPT or through Claude or through Codex, it actually means that they desperately do need to trust the data that is given back to them as the output. So they've come back to S&P and said, hey, we need to renegotiate our contract and we need you to help us make sure that when we use your data in different contexts, it is actually your data that's coming back and not something else that's been trained into the model. And so S&P have actually expanded some of their contracts, some by 35 to 45%, they said, because they are now becoming a beneficiary of vendor consolidation. So in this world, yes,
Mm.
absolutely, some data providers with less unique, less proprietary, less useful data are getting disintermediated. But those with the most valuable data have actually found that what they offer becomes even more valuable. And so that's been really, really fascinating for us to watch S&P's sort of data house becomes so valuable. It's underpinned by their ratings data, but it's expanded across the board. Another great example of proprietary data is actually the payment networks, so Visa and Mastercard, and separately Amex, which I'll get to. But Visa and Mastercard are these completely irreplicable open networks. Visa reaches 18 billion endpoints around the world, which is almost hard to get your head around.
Huge scale.
Yeah, it's just it's kind of impossible. But what they've done over time is that they've tokenized, and not in the AI sense of tokens, but tokenized as in a digital representation of all the cards uh,
Mm.
around the world. And what that means is that they can, as they distribute their value-added services, which is largely fraud prevention, but there's a range of other services that they provide within a payment to the bank issuers and the merchants that ultimately protect consumers. They're able to update all of that in real time, and so then they said, for example, tapping a card will trigger 400 fraud scores that are checked in real time. But they're able to update all of those services now through that tokenization network. So they've actually quietly built the largest distribution network in the payments ecosystem
Mm.
on top of their sort of decades of building out their open network. Same goes for Mastercard. Value-added services are almost half their business now on top of the networks, and that provides a real valuable service to merchants, consumers, and banks around the world that um, probably goes it's probably taken for granted, if I'm being honest, because you don't really think about it when you're tapping your card or now tapping your phone
Mm.
to pay for something that there is sort of an embedded cost in that because of the potential for things that could go wrong. But it's largely unseen because of the way they're able to use their data at scale and via the distribution network. Um, Amex as well, just quickly, same thing, but they're actually a closed loop network. So in some ways, they're even more advantaged. They have an issuer. They are the issuer and the network and the merchant acquirer in a transaction. So they actually see the full end-to-end transaction, and so they get all of that data that drives their fraud prevention, and so they're considered one of the best in the world. It's why they're able to compete with Visa and Mastercard to some extent, because they're actually able to offer that full level of security viewpoint, and fraud
Mm.
prevention, in the same way. And so they've all got the same sort of applications. They're all considered, all Visa, Mastercard, and Amex, are considered right in the wheelhouse of agentic commerce, and any of the sort of any of the big tailwinds that are coming into payments and commerce. They are absolutely going to get swept up in, and if anything, they're really going to drive forward, because there's honestly, you can't really have any of these agentic transactions without the safety and security that's built in, and so they're on the forefront building a lot of that technology. And it's all underpinned by the data that they see every day.
Mm.
Trillions of data points that embedded in the transactions that they see every single day across the board.
Yeah, it's almost hard to get your head around it. But it feels like the data flywheels are spinning really fast, where you've got these enterprises with extreme scale, and that's driving the production of more proprietary data, which then in turn drives better services, better products, which then drives more scale, and so on and so forth.
Yeah, it's fascinating too, because like we've seen a lot of these stocks sell off, and the some of the impression is that these AI companies are going to be able to extract data and insights on their own. But it seems very, very clear to us, and very, very clear to these companies, that the AI decisioning is kind of useless without the underlying data. And this data updates in real time, and it changes, and it's very dynamic. And so, yeah, it's going to be increasingly important, I think, as we let agents do more and more in the world, that you actually are utilizing the scale data that the companies like S&P,
Yeah.
Visa, and Mastercard provide.
Yeah, it'll be interesting to see how the market's perspective on this evolves.
Yes, exactly. It's a good opportunity for us in the meantime.
For sure. So, Lucky, you've shared a whole bunch of insights around Visa and MasterCard, and you also shared that transparency in financial services is sort of a big structural transformation that we're seeing more broadly. Can you share a little bit more about what you mean by that, and what you heard?
Yeah, well, we're in a quite fascinating time for the alternative asset managers. They, as we've described before, have enormous tailwinds behind them, in terms of the adoption of alternative assets, but they're under a bit of pressure at the moment because private credit. Safe to say it's in the doghouse, and
Mm.
a lot of their businesses are under pressure. It's different by business, but we did see KKR and Blue Owl and Apollo. They were all at the conference, and so we were able to hear from them. But we also did see a lot of the service providers around private credit, and one of the big transformations that's happening, I guess it goes alongside the public to private transformation that's happening in terms of asset allocation,
Mhm.
is actually around the transparency of private assets. It's almost pushing
Mm.
the private asset, which its advantage had always been that it was, I guess, less transparent and
Mhm.
less liquid, is actually becoming more and more like a public asset. And so, what do I really mean by that? I mean that everything from credit ratings, benchmarks, and even just the underlying data of what's going on in your portfolio, or what do the assets actually look like that you've invested in. That's now sort of being demanded by LPs, and so you've got companies like S&P again, but Moody's as well. They're actually seeing a lot of inbound demand for private credit ratings, because you've got owners of private credit that also own public credit, and they would like a third-party independent uh, ratings provider that they can compare to their public credit, and essentially they can
Mm.
see what the quality of the stuff they own actually is. So
Yeah.
they've S&P saw that their private credit revenue is now in the hundreds of billions of dollars. It's growing 25% year over year. It's massively accelerated, and there was a big question when private credit was getting started as to whether S&P and Moody's could be sort of left out of this transition. And so, of course, it took a crisis, but turns out actually no, we would like to know what the quality of our loans do look like. And so Same thing, MSCI, who provide a lot of the benchmarks. Same thing, they're going to provide benchmarks so you can get something to compare it to as you're looking at the price of your loans, and even private equities going forward. Anything that they can turn into a liquid market, they would like to provide a benchmark around it. So a lot of, if you're really forward looking, there'll be tokenization of private assets, which will
Mm.
be able to be traded on a secondary exchange. But they're certainly right there. They're looking at all of these sorts of things, and they're hoping to provide a benchmark around it, in the same way that S&P and Moody's will provide a rating for all of it. And it's not just the service providers and the LPs around it that are doing this. Apollo's actually leaned all the way into. They would prefer, because they think they're a leader and they actually have high quality loans that they're writing. They would like to solve the sort of opaque underwriting and investment process that happens in private credit. And so they've partnered with Intercontinental Exchange, which is another one of our portfolio companies, to give them all of their portfolio data. And
Mhm.
Intercontinental Exchange is using Apollo's portfolio data as sort of their anchor partner to create a range of, I guess, unique loan qualities and data points that they can then point to, and then they can and that they can use that, to offer buyers and to offer owners of these assets, such that they have real time updates of the essentially the quality of what they own. Um, and uh, and that's going to be fundamental if you think that private credit and private equity are going to ultimately be able to be traded on a secondary level, on if they're going to be traded on secondary exchanges. It's sort of impossible to think that you're going to end up with a liquid exchange without some underlying data around the things that you're buying and selling. It's one thing to trust the brands of Blackstone and KKR and Apollo in the first instance, because they have such high quality underwriting standards and just historical performance. But yeah, going forward, you're going to need a lot of the data assets alongside the ratings and the benchmarks, in order to create liquid exchanges going forward. So it's a really long term transformation that's happening here, but it's really picking up speed right now. And it's
Mhm.
come as a result of the crisis, and it's quite fascinating. So as you were saying with Intercontinental and Apollo, Intercontinental are also talking to KKR, Blackstone, all the other big private credit writers, and they're going to be working with them too. So they're hoping to build an industry standard for data across the whole industry. It's going to create a lot more activity in this industry, and probably more important than that, actually, the transparency. It's
Mm.
going to mean you don't have sort of individual investors that got sold semi-liquid portfolios of private assets that didn't really understand what it meant when it was semi-liquid, and now they can't sell it on because they finally understand that they can't redeem. There's lots of challenges happening in private credit at the moment, and it's sort of left the industry at a bit of a standstill to some extent. So it would be great to have some transparency around what's going on sort of underneath the portfolio investments at the asset level, and that's what all of these companies are hoping to provide, and it'll be a benefit for the entire industry. So it's really positive.
Yeah, super interesting. I feel like if ever there was a time to say data is the new currency, it does feel like that time is now.
Yeah, absolutely. No, it's certainly something that we're very attuned to. It's driving a lot of our portfolio decisions, because it's just so hard to look to the future without any of these assets. So it is the incumbents, but they are just so well positioned for what we view as the AI future.
Cool. Yeah, for sure. Lots of exciting themes coming out of this conference, and certainly ones that reflect the views that we also see through our research and our work at Montaka. And all of this is obviously happening against a pretty challenging macro backdrop. Would love to hear about what you heard and how you think this sort of impacts our work in global equities.
Yeah, I mean it is. I would say it's a tricky time to be looking at markets. Interesting to see, like, the S&P is at record highs, it seems, every other week. There's occasional little shocks here and there, but then if you really go read the news, you see all sorts of issues with the economy. And so we heard from Jamie Dimon at JP Morgan, for example. He said the complacency is abound. You've got credit standards stretched, government deficits are crazy, there's wars that are ongoing, there's just lots of risks out there that I guess he's worried about. He said his base case is that we carry on and everything will be okay, but he's very worried about these risks. He on top of seeing the risks, though, he said JP Morgan itself has been over earning in terms of its return on equity targets for 8 years now. He said their stock's overvalued, and he actually sent all of the bank stocks down while he was speaking. But so there's certainly risks out there. We already talked about some of the private credit risks. There's lots of leverage embedded in that, which could sort of come to bear if the economy got worse, or if some of the risks that Jamie Dimon was talking about actually came to fruition. And then on top of that, I guess on a broader macro level, inflation is being seen across the board. Chipotle, for example, in the restaurants, they aren't pricing enough to catch up with inflation at the moment because it's across avocados, beef, dairy. They've got a significant margin dislocation coming through because of that. The issue is that the US consumer especially continues spending. As according to a lot of the CEOs that we saw at the conference, we're likely to see higher interest rates for longer, just as a result of that. And until we can sort of get a handle on inflation, it may look a little bit more like Australia, where you actually begin to raise rates to get on top of it, unless something cracks. So it's quite a delicate place at the moment. And the economy is really being driven by the upper tier of earners. They call it a K-shaped economy. So Amex, which caters to the higher income earners, they said that their platinum cards, their spend is lifted 6% above expectations. And it's driven by the younger consumers. The average age on that card has gone down to 33. So the higher earners continue spending, and they're sort of keeping the economy in shape, but with a lot of sort of dripping little risks around that we're quite wary of, and it makes it hard to look at the S&P at record highs. You've got $1 trillion IPOs about to land. There's plenty of money flowing around, but pushing assets up, and it's certainly not being felt in the real economy in the same way. So it's a shaky picture, to say the least.
Yeah, it's a super interesting disparity almost.
Yeah, absolutely.
Lockie, this has been a fantastic conversation. Really appreciate you sharing what you heard on the ground. For our listeners, if you want to stay across Montaka's thinking on these themes, you can find us at montaka.com. Until next time. Thanks, Lockie.
Thanks for having me.